Hello, this is Joe Boston with Real Estate for Life. I'm excited to be discussing money, and it's our money month at the Dallas Real Estate Investment Group. So we mirror kind of what we're talking about at the investment group, but we want to spend a whole month talking about what's really the reason why we do what we do in most investments is to make more money and to understand how it works. And so I couldn't think of a better person to invite to have on the podcast than an individual that's worked with me since the beginning, pretty much when I moved here to Texas and started doing real estate loans for rentals. And so I was really, really enamored by how I could actually buy them and then rent them out and be profitable, and then over time, develop wealth. And so, one things I wanted to do is tell you about the Dallas Real Estate Investment Group. We are a community-based group that provides real estate training, education, and transaction assistance to individuals that want to learn how to do real estate investing. But also, we have networking so that you can develop relationships with like investors, but also people that are there to help you, like the individual that we're going to have on our podcast tonight. And so, without further ado, I have with me a gentleman by the name of Ron Corcoran. He is the senior vice president at the Texas Republic Bank. And Ron and I have been together north of 10 years now. And it's really, really exciting because now those properties that I was fortunate enough to develop a relationship with Ron have quadrupled in value. And, we're going to talk about not only, kind of the process where it is from where I started to where it is now, but also highlight kind of an overview of how the lending industry works and some of the terminology and how that actually applies to what you're doing when you're trying to obtain a real estate investment. And then also, if you're looking to, work with him and his company. So, Ron, thanks for joining us tonight, and couldn't be more excited to have you.
Well, Joe, thanks for having me. And as you were talking there, I did go back and look, and it was in March of 2013 that we did our first deal together.
So 10 years, right? Wow.
Yeah,
Yeah,
you're right on.
that's something else. I can't believe I've been doing it that long, but thank you for believing in me. And I mean, I know that it was you and your team. We were working together, and I'm glad that I was buying rentals then, because I wish I would have bought like 20 more or 30 more. Why didn't
Yeah.
you tell me, man? Come on.
Well, if we all knew then what we knew now. So,
Yeah, that's good. So, really quickly, can you provide an overview of how, when we talk about interest rates, in the climate we're in, people are real skittish now buying, because of the interest rate hike. But how does that process work, right? There's a prime rate, and then there's a rate that you guys actually apply to that will eventually then transcend to the customer. So, can you give an overview of how that
yeah,
works?
Joe. So, well, yeah, sure. The rate that we hear most commonly, the prime rate, has several meanings. But in terms of how it affects the consumer and a borrower for real estate, who's borrowing money for real estate, you're going to hear the term prime or Wall Street Journal prime. When they say Wall Street Journal prime, they really just mean that's the source that you can go to look at that prime rate. The Wall Street Journal being a very common, well-known, well-circulated publication. Nowadays, you can just go online and grab it versus having to actually go get the paper. But Wall Street Journal Prime is driven by the prime rate that the Federal Reserve Board sets. They meet approximately 10 times a year and look at rates and make changes to affect the economy, to offset inflation, unemployment, other factors like that. And right now we're in what you call we've been experiencing a rising rate environment. We have inflation that's going on, and so interest rates. The Fed is increasing interest rates in order to slow down the inflation, and so we've seen prime jump from as low as it dropped to 3.25%, and over the past year it has climbed to its current rate of 8.25%. The Federal Reserve Board will be meeting again later this month. I think it's actually next week or the week after, and the sense on the street is they're possibly going to do another quarter point increase to prime, and talk out there. The chatter is that there may be another one after that. So we're possibly looking at prime going to 8.5 or 8.75. So that's the prime rate. We refer to it in our business as the index. The prime rate affects our cost of funds at the bank, and so as prime goes up, money costs us more, and therefore the rates we have to charge the borrowers goes up, so that we maintain an appropriate spread and margin to run our business. And so for investors, you typically will find those rates would range anywhere from maybe a half over prime to as much as 2 over prime, depending upon the factors of the borrower in the project. So right now it's a very tough time in terms of the interest rate. You'll see, as an example, we had loans that we made several years ago that had a prime, when prime was down in the 3s, those rates were in the 5s. And if they hit an adjustment and they jump up to a rate of somewhere in the 9s, that payment literally could almost double just because of the interest rate. So it can be a big impact for an investor on their cash flow if they have their payment jump by that extreme amount due to these rates.
So, from what I hear you saying, is that right now, if they do have an interest rate hike and it does go to 8.5, does that mean that the customer could be seeing a rate of 9 to 10%?
Yeah, they could, again, depending upon how the underwriting works out for the actual rate that's offered to the customer. There's going to be a spread over prime. In other words, the banks are going to charge X points over prime. So let's just say that Joe, you bring me a loan and I do all the underwriting. I said, Joe, I can offer you a rate at 1 point over prime. Your rate today would be 9.25. The prime of 8.25 plus the 1% point. But it could be some borrowers may warrant a half over prime, and some may warrant 2 borrower / project. So there's a lot of factors that go into, from the bank side, that go into determining what rate we can offer. It's really a risk analysis that dictates that.
Right. And that's by customer, yes, correct?
Yeah. So each borrower is going to be evaluated differently. Some borrowers have maybe a lower risk profile because of experience, because of capital, and various things of that nature, versus someone who may be newer to investing. Maybe it hasn't accumulated as much reserve dollars, capital to put into projects. So the loan to cost is a factor, and then you look at the property itself. The amount of work that's needed. The condition, the age of the property. So there's the amount of rent it can generate. So there's a lot of factors that go into the pricing of a loan. And so the short answer right now is that those rates, I would say on average, if an investor is looking at a property and they're putting together a budget, I would say they need to use a rate of about 9.5 to be safe, to not be fooling themselves as to what that money would really cost them right now.
Wow. So that's amazing, because as we look at history, I mean, just you and I were first getting this started 10 years ago. I was screaming bloody murder, I believe, at about 5%. And I was thinking that, you were taking advantage of me. Well, I wish we could go back to those days, right? That's something else. Do you see historically a pattern like this would last about a year, 2 years, then start to trend downward? Or do you think it's going to held steady for a couple years and then maybe go down very slowly. Because from my understanding, they're trying to, right, like you said, slow the economy down. So it'll stall and then demand will, there'll be more inventory and then it kind of recycles, right? Is that correct?
Well, everything goes in cycles, and it's really hard for me to give a feel for if this is going to be a short time, a short period cycle or a long term cycle. It's really going to be a factor of how the economy and the markets react to these changes in rates, and we're continuing to see an increase in the rates, and that's because the market is not reacting. It's not pushing back the inflationary factors as fast as the Federal Reserve would like to see happen. So they're continuing to increase the rates to offset that. And I've not really seen a lot of pushback on prices in a lot of different things. It's not just real estate. It could be as simple as a gallon of milk, what that costs, and then go up to the $200,000, $300,000, $400,000 real estate purchase. So it's a full array of products and services that do affect the inflation. And we've maybe seen some areas where we're seeing prices maybe stall, not really continue to increase, but I haven't seen a lot of pullback. And so that's the reason why the Fed is continuing to consider increases in the rates to get this inflation, in their opinion, under control. There's a lot of opinions out there as to, are they doing it the right way? This has been the steepest increase in interest in the prime rate that we've seen in history. In other words, if you were to look at it on a graph, that climb, we've never gone from what was we were at 3.25 on March 15th of 20. So in 2 years, we've gone up 5 points. And so that's been a pretty huge increase over a short period of time. Once they feel like they have this inflation under control, they'll stop increasing the rates. And then my speculation is they will slowly bring them back down. And where rates should settle in at, getting back to a prime in the 3s is probably too low, just like having prime in the 8s is too high. Maybe somewhere in that 4 to 5% range is a more realistic and a more a prime that can allow the economy to have a good consistent growth, not be what we saw a few years ago. We're seeing a huge amount of increases in the prices, especially of real estate, that partially led to what we're seeing now. So it's a tough job for them to figure out the right approach. And right now, this tremendous increase in rates, it doesn't appear to be having the effect they want on the economy, but it's really beating everybody up on terms of what it costs on existing loans that may have adjustments to their rates or new loans.
So when you look at,
so it's a tough time from the rate environment to get a new loan.
Right. When you look at these large home builders, though, so kind of directing this towards real estate, I see Lennar Homes, people like that, offering a low 4.5 or 5% interest rate. Are they doing that because they actually have private money? So or they have their own lending and they're not actually using that same criteria? How was that?
Well, either my guess is that they're not using their existing lending lines to be able to do those rates. They have basically their own private money. And you think about when you have a home builder that has spun off a lending arm to finance the homes they're building, they are able to offer a lower rate to encourage someone to buy their home, because it really just kind of eats in on total. It just kind of eats into their profit on that house. And so that's how they can kind of absorb that. They realize they're not going to make as much on that house, but they need to get it moved. And so they're able to offer a lower rate, and they just won't make as much money on the house. So a home builder is a little unique. If you have a Lennar or some of the bigger home builders that have created their own mortgage companies, you can't really look at those separately. You got to look at it collectively. And so that's how they get around some of that right now.
Right. So I've been noticing that on, with these commercials, and I'm like, well, obviously it's like a private money source. They've spun off, so I wanted to talk about that, get your thoughts about how that works. So right
Yeah.
now, in our world, when you talk about real estate investing, there's fixing and flipping, and then there was the rentals, right? There was the rental market. Then you have all these other revenue generators, so the commercial type real estate products, like your self storage and your maybe your short term rentals and your mobile home parks. But for us that were starting, it was fix and flip and rentals. And so I kind of want to talk about that a little bit right now, because you and I kind of talked about this, over the last couple of years and where this market has trended. So there's something called the DSCR loan. And so can you talk a little bit about that and then how that works and kind of that structure for you guys, how you apply that?
Yeah. So when you're talking about a debt service coverage ratio loan, DSCR, that's more for a rental. And what we're looking at is we run some calculations to see how well the cash flow, the reoccurring monthly cash flow covers the debt service. And so there's a model that really every investor is probably using a very similar model. We as a lender, we've created here at Texas Republic Bank a way that we want to analyze those properties, and we're going to be a little more conservative in how we view them. And so sometimes our calculation may be a little tighter than an investor would use, because we're kind of looking at the what ifs. If something changes with that in the economy, something changes with what rents are generating. But that's what you basically need to look at that as an investor. You need to think about. I would suggest you try to think about how's the lender looking at that property, and how are they going to analyze it. And the debt service coverage is one of the crucial factors. Loan to value is another major factor, and then reserves that the investor has as a third. That's kind of probably the big three, I would say.
Right. So it's really tough. You and I talked about this. It was a struggle when we were buying houses at $80,000 years ago. And, because there's a cap when you start talking about what people can afford realistically, so we're at about the $2,000 to $2,500 price point. And so when you start talking about home values now at 180,000, I mean, this is investor prices, not new home builds. And so you're starting to talk about buying these rentals anywhere north of, I'd say, 150,000. And then you have rehab. So let's say you're at 180,000. So using that example, I think it would be tough, right, with your model to make that profitable for a rental long term. Would you agree with that?
Okay, say that last part one more time, Joe. So I know you said
So
I
think that would be tough for an investor using your model to make a long-term rental profitable or make it work, right? At 180,000 at, let's say, 2,000 to 2,500 a month.
Yeah, that would be those numbers. That would be very tight. And so that's why doing a debt service calculation on the front end when you're looking at a property should help an investor determine if that property makes sense as a rental. And so what we find is with where we're at now, we've seen a shift in investors that were doing a lot of rentals 5 to 10 years ago. They're now looking at properties not as a long-term hold as a rental, but more as does this property make more sense to fix it up and flip it, if you will. So we've seen that's where most of the opportunities are coming now in terms of from a lender standpoint of making loans. It's lending to investors that are flipping, not holding as rentals. Now, I'm not going to say there's not some properties that someone could pick up that make sense as a rental, but the percentage of those is a lot less than it was. And it's actually even become tough on the flips. The prices is one thing. We see that that's the first thing we look at. But the other two things that have been hitting investors extremely hard are taxes and insurance. We're seeing, I know in my area, being in the North Collin County area, I've got a few investment properties myself, and I've had tremendous increases in the values of my properties. And therefore, even though the tax rates haven't increased, the values have pushed, I may be spending another $1,000 a year in taxes on a property, where now I got to go in there and there's a little bit of a lag time before I can go in there and get my rates increased, the rental rates increased to offset that. And I had a 70% increase in my insurance on a couple properties in Frisco, and I haven't filed any claims. It wasn't due to anything specific to my property. It's just we're all being hit with a cross-the-board increase in rates due to the storms that we've had in general in North Texas. I mean, you look at think about what's happened over the past couple of months. We've had a rough June and into July with storms, and you think so. So I don't think we're going to get any relief on the insurance. I'm hoping that there's enough people raising their voice in Austin that at the state level there'll be a little bit of a pushback on our local taxing authorities to back off on these the taxes, because they're also they're making it tough on investors for sure, but they're also making it tough on just general homeowners, to be able to afford these properties. So when you look at increasing interest rates, the increases we're seeing on taxes and insurance, it really leads to an investor to do a lot of homework and due diligence on the front end, so they can kind of maybe pass on some deals that don't make sense, jump on the ones that do, and not get themselves in a situation where they have a bad investment and some dollars tied up longer than they would they were initially anticipate or wanting to allocate those funds for.
Right. That's one of the reasons why I think, Airbnb and a lot of those revenue models took hold as well, right? Because you could offset. I mean, it's more of a business model now, not just a stagnant, I guess, a steady rate of income, because now your expenses have gone through the roof, like you mentioned, and you couldn't offset it. And so, that's one of the things we've done, Ron, is we've looked at other alternatives. That's why I mentioned the revenue models, because now you can take homes and rent them out per room, let's say, or the short-term rentals, because, like you said, a lot of myself and a lot of my friends, we don't even really look at renting them anymore. Just from the standpoint of not only is it the reserves, but you said all those things that hit your bottom line, you might not even break even.
Yeah, it can be tough. And again, you think about you enter into a lease agreement, and I would say most leases are probably 12 months. Some may go into something longer, 18 and 24 months. But if you don't anticipate, and honestly, I wasn't expecting a 70% increase in my insurance. I was thinking I'd have a little bump in the rate, but 70% was a shock to me. And so if you're locked into a rental rate, long-term rental rate, and then you get hit with an increase in your insurance, you got to wait until you have an opportunity for that lease to expire to go and either increase your rates or then you may be dealing with someone vacating the property. Now you may be sitting on a month or two to get put a fresh coat of paint on there, clean up the carpet, whatever, and get a new tenant in. So there's a lot of things you got to think about that could at the end of the day, at the end of the year, when you look back at your total net profit, it may not be a net profit for that particular year.
Right. So where do you see
And
opportunities
so just
if you
important
have
things to
seen
keep in
any?
mind.
Yeah. So where do you see opportunities from your standpoint with your clients coming in? What would you say you're seeing right now?
Well, really, the best area that I've seen lately with good return on investments has really been brand new ground up construction. But that does bring into that. That's I wouldn't necessarily suggest an investor who hasn't done any type of real estate investing to jump in with a ground up construction unless they had a good contractor that they were working with, because ground up there's a lot of different components than just taking an existing house and doing some rehab work. We've had investors that have ran into things they didn't expect on existing properties. Maybe they didn't realize the foundation had issues or the roof, or they get in there and then the city gives them a hard time on some permitting if they're having to deal with the electrical, the mechanical, the plumbing. But ground up has all of that. I mean, you're starting from square one with prepping a lot, doing your foundation, you're roughing your plumbing. So you got a lot of permitting, a lot of design work. But right now, that's where we've seen the best opportunity. So if someone can find a lot or some lots at a reasonable price and can put together a floor plan that they can build at a reasonable price and get it built fairly quickly, get it built right, and at a price point, probably I would say not exceeding 400,000. That those properties should move fairly quickly. We still have a lot of people moving to North Texas.
Yeah.
I don't have exact numbers, but I mean, I seemed like I heard the other day in Denton County that they're getting it's like 81,000 people a year or something. I mean, and then you start playing it out. They start breaking it down to one person every 30 minutes or something. I mean, it's these crazy numbers when you think about how many people are moving, and that's just in Denton County. That's not talking about Tarrant County, Dallas County, Collin County. And so North Texas is still a very attractive place for people to move and live. And so that's we still need housing for those people. And but at the same time, we don't want to overbuild. So you mentioned the Lennars and some of the big volume home builders that go in there and build out a whole subdivision versus an individual who's just doing one or two. So you got to be selective and do some homework on that. You talk about the specialty products. We've had some people who've had some success with homes that are let's say they're near a lake, or they're located such that they're attractive for a short-term rental. The VRBOs and the Airbnbs. We've seen some opportunities there. Now, as a lender, the banks that I'm familiar with have been a little cautious of financing those properties. We usually want to look at it from the standpoint of does the debt service and do all the metrics work for that property to be held as a long-term rental. And if that's the case, then we're partnering on the deal and the borrower's going and doing it as a short-term rental and potentially getting some good lift in their income. But if the short-term rentals doesn't work out, we feel comfortable that property could be put on a long-term rental, converted to a long-term rental and still service the debt.
That makes sense.
Yeah, so again, it's still from a bank perspective, we're looking at it from a more conservative view. One thing that I would caution investors to research is make sure that if you're looking at a property and you want to use it as a short-term rental, that there's not anything that the city's doing to prevent that. Because we do have some cities that are coming out and trying to put moratoriums or put limitations or actually restricting altogether the short-term rentals. And there's probably going to be some legislation that will be coming out at the state level to control that a little bit. So just I've literally have met some people or know some folks that had properties that were short-term rentals, and then the areas they're in, they were notified that the HOA or even the city has come out and is working toward restricting that, and
Right.
can basically shut.
Yeah, the city of Dallas just did that. If it's zoned single-family residential, then they're preventing that. Some loopholes if it's not zoned. I mean, if it's zoned multifamily or commercial. But you're right. I think that that's something that people have to really be cognizant of is instead of just buying it, just arbitrarily, they need to look at the rules of that city and that municipality before they jump off the cliff and buy it. To think they're going to do that.
Yeah. We've had in Frisco as an example. Frisco's been one of it's the only city I know of that's really taken the opposite approach. They've said, let's allow the short-term rentals, but let's control it. So they require you to actually file an application and pay a fee. So they're getting their cut of basically licensing or permitting that property to be a short-term rental. And so, so you may see some of that. You may see a shift, and that may make it where some municipalities realize there's an opportunity there to control it, to get some money off of it, and be aware of what properties are the short-term rentals. So, but it's certainly an area I've got friends in customers that have properties in these rural areas by lakes, for example, and they're getting, it's amazing, $300 to $400 a night on some of these properties because they have a nice view or they have lake access. And so they can take a property that may have rented for $2,500 to $3,000 a month, and they may be getting $8,000 to $9,000 a month. And it's at least 20 out of 30 days in the month. So correct. The short-term rentals do have a little bit different expenses. You're going to have your you got to pay the VRBO, the Airbnb companies for listing the properties. You got to pay someone to come clean and prep the house before and after. So you do have some. So it's a little bit of a different model in some regards. So you got to adjust in addition to your typical P&I if you have debt, taxes, and insurance. But opportunities there. So you talk about opportunities. That's certainly one, but you got to go in and do your homework.
Right. So do you think the fix and flip model is working as well? Do you see a lot of that going on?
Well, we're still seeing some of it. It is slow, and the fix and flip doesn't get impacted as much by taxes and insurance as a rental. But what's happened on the fix and flip is the prices of buying the house have gone up. The cost of rehabbing the house has gone up. And so you now need to kind of convert that to what you can sell the house for. And, and so the profits there have tightened a little bit, and it's gotten to where a lot of deals, a lot of properties that are presented that I've seen, we collectively, me and the borrower, have passed on some because just the profitability margin was so thin. If there was any unknown, anything unexpected that happens, it could eat your profit immediately. And again, I mentioned previously, if you go in there and look at a house and you find out after you get into it that there's a foundation issue, or there's maybe some plumbing work or the roof. So if you don't budget appropriately on the front end, and you have something unexpectedly happen, it can really wipe you out in terms of your profitability. And then you get things, people that bought the fix and flips, they got them done. And now they're trying to sell them, and they're having a hard time selling them. They're probably selling typically to a homeowner. Well, some of these homeowners can't get financing now because of interest rates. So now the investor's having to carry the house for a longer period of time. So there's all kinds of things that can happen that you kind of probably, in my opinion, you want to work some contingencies into the budget. Just to cover that, and hey, someone comes to me and says, I can buy this house, I can fix it up in 3 months, it'll be sold in 6 months. Well, I may say to them, well, assume you're not going to sell it for 9 months. Put your budget together with that conservative viewpoint, and still shoot for what you felt you could do. And if you're successful, then so be it. But if you weren't, you didn't get hit with something unexpected, and that's where the reserves come in. That as a lender, we want to see reserves because we want to have confidence that the borrower has the ability to cover any additional cost of rehab, cover the cost of interest, taxes, and insurance if they're having to hold that property for a longer period of time.
So is that 3 months reserve, 6 months
Uh,
reserve?
well, I'd say you want 6. I'm not going to say that only having that having 3 would prevent you from getting financing, but having 6 or more would be more
Sweet
ideal.
spot.
Yeah.
So what other products do you what do you sell? Do you have?
I'm sorry. Say again.
What other products do you have? I know you do the fix and flip model. You have obviously the rental model products. What other loans do you guys offer?
Well, for single family investors, that's really about it. We do have a mortgage company, so if someone that sometimes can work for a long term rental, we can look at putting on a longer term mortgage, which could sometimes bring the P&I down and therefore help the cash flow. But in terms of single family investors, that's really about it. Now our bank we do lending in all sectors of real estate. So we do commercial, we finance churches, office buildings, retail centers, warehouses, so the full spectrum of real estate we look at. But in terms of the single family real estate investor, you really have what I'd say is on an existing home, you have the rentals, buy, fix it up, rent it out. The flips, buy it, fix it, and sell it, or do new construction to either hold and rent or new construction to sell.
Right.
And
So what are you seeing from commercial? So word on the street that's struggling some too, right?
well,
Because people now can work from home, and that's caused a little bit of upstir in the commercial segment.
we're seeing a unique. With commercial, you got to kind of break into to subcategories. And I'll talk. You mentioned people working from home, so that kind of breaks you think about office. Office is probably a tough sector right now. One of the factors is what you just mentioned, the work from home aspect of it. But retail seems to be holding its own at the moment, and so you look as you drive around the metroplex, you see a lot of stuff come up, and some of these retails that are being put in the right locations. Maybe they're close to the entrance of a subdivision that's got several hundreds, if not thousands, of homes. Where you have the Starbucks is in there. There may be a Subway. There may be a place for someone to get their nails done, a hair salon. Those seem to be doing well. But the office space is a sector that we're very cautious of right now. I have a sense that it's a little overbuilt, and
right.
Now, storage is a hot item. I think it's going to continue to be strong. But again, that's a whole different world of someone that if you're looking to invest in self-storage, if it's existing, that may be, just do some research on it. But if you're looking to do some type of construction of self-storage, there's a lot of things involved there, but those can be very profitable ventures in the long run. The RV parks have had a good run of late. Location's key there. I do worry that we may be getting in some areas a little overbuilt on the RV sector. And I think now that we've come, when COVID hit, the RV, the recreational vehicles really kind of took off a little bit. And I think they're kind of coming back down to their more normal levels. But I still sense that a lot of people are traveling. They're doing their traveling more local in RVs and Airbnbs versus maybe some of the vacations where they would fly to some distant location for a week or even out of the country. And I think that will continue for a while. So I sense those shifts are happening. If you get into the larger commercials, what I think is, creating a team of investors is the way to go there. And that's a way to be able to get in a deal that's going to cost a lot more and not have, not really go up there and generate or create a large pot of cash yourself. So you kind of share that with investors. So we do see, I would say that probably 90% of our larger commercial transactions are groups of investors, anywhere from 5 to, I did a deal. It's probably been about maybe a year and a half ago. Had 65 investors.
Really? Wow.
And so it was about a $10 million real estate play, but they had a large group of people, and that allowed them to come up with the cash they needed on the front end for a down payment and reserves and things like that.
What type of commercial was that? A warehouse, or what was that?
That particular one was. It's really going to be a multi development phase. That particular part was just the land acquisition. Okay. It's going to be converting or adding to it here pretty soon. Will be some dollars to develop the property. It's going to be that property will be developed into. It's going to have the interior is going to be residential lots for homes, and then the exterior that it's on hard corners. So they have 2 streets. They're going to do some retail. And so
What area was that located?
It was in Prosper, and that they'll have a hard corner where there'll probably be like a gas station will go, and then you'll have a couple wings of some retail space that will have, as I mentioned earlier, maybe a donut shop, dry cleaners, nail shop, coffee, that type of, maybe have a few little, urgent care, a dentist, eye doctor, things like that. Yeah. So, but again, you're talking, some pretty sizable dollars on those projects. And so unless someone's really accumulated a good amount of reserves and capital, partnering with others is what, sometimes can make it happen.
Yeah, that's interesting. So yeah, we're seeing that too. I mean, even in some of these smaller, deals that we're putting together, projects, you almost have to joint venture, because his houses are 200, 300,000. I mean, it's getting tougher to scale, right? I mean, it's a tougher deal now, and now lots as well. I mean, you're talking about doing new construction. I mean, going 5 to 10 years ago, those lots, have quadrupled. I mean, 10 times they've gone up in prices. So, I mean, and they're selling, right? Because you can't make more land, obviously. So,
yeah, we've seen definitely the increase in the lots, and I'm not really sure. I was involved in a project over in Granbury where the lot was 40,000, and now those lots are going for 75. And
right.
So people that are builders are trying to buy those lots now, and then you add the increase in construction. They'll do okay, but the margins won't be quite as high, even though the prices are up there. But I do worry about, what is the rates going to do to those investors, those builders, because they may have to sit on those houses for a little longer, and those type of rates are usually going to be at least 1 over prime, so they may be paying in the 9s right now.
Wow, I just can't. So, in your opinion, we're reaching almost the hour point here. So, if I was a new investor, single family, and I walked into your office like I did 10 years ago, what would your recommendation? What would you say to me now? How would I want to be a successful real estate investor? I need you to help me do that. What would you tell me?
Well, don't get overzealous. Be very cautious and do a lot of homework. Realize that you may look at 20, 30, 40 properties before you find a few to put offers on. So don't get blinded by what you hear people talk about real estate investing. It can be good. It has been good, and I think it will continue to be good. It's just not going to be at the rate that it was before. So just cautious, build a good team, a good network to get information from. If you're going to, typically all these properties are going to have some level of rehab. So you're going to need some people on the construction side. So you need to have resources there. You need to find someone who can work with you on the lending. So just build your team from everybody you think you may need, from lender, insurance company, contractors, resources like you, Joe. I mean, so groups that mentor and put investors together to share ideals and thoughts, I think are very, very beneficial, especially for someone new. There's so much that can be learned when you meet with other investors. I've got some investors that some of them own hundreds of doors, and they still meet weekly or monthly with their investment group they were meeting with 20 years ago. And these guys are very, very experienced. These are the guys that I'm learning from every time they come in my office, and they're still meeting with their other investors because it never fails. Somebody experiences something that they share with the group, or they learn something about, hey, have your accountant look at this in terms of filing, something on taxes to maybe save some dollars here or there. And there's just, or call this insurance company that they have a new, this is a good company to try to get your insurance with. So sharing and networking I think is also a very crucial part of it. That also leads to possibly forming some alliances to partner with. And so I think that for a new person, that's definitely important. Trying to go out there kind of cold is tough.
Right. Yeah, it's a much different environment now. I mean, I was a lone wolf.
You got to save a little bit of money. You got to have some.
Right. So that's exactly my point. That's where I was going, because a lot of people think, that you don't need reserves, and you can, a lot of times they're like, well, I don't need much money to do this business, and that's the one thing I would say is true, but you need access, right? And so access that comes, you need experience. You need, like you said, alliances, because if you don't have the money, you need to have someone that does, right? You're looking at reserves, so you can collectively come together and make a deal happen. That's the one thing I've learned. Instead of being a lone wolf, you can joint venture and work together, to be successful, right? You might not make as much, but you can still get experience. And then when things change in the marketplace, then maybe do, scale, do a little bit more,
Sure.
because it's a different environment. So Ron, thanks for spending time with us. And again, we're hitting the hour point. So I wanted to definitely have an
I appreciate
opportunity
it. Hope I was able to add some value to your investment group.
Oh, definitely. And you'll be around me forever. So that'll never change. And I want people to be able to get in contact with you, because not only are you a valuable resource, but in addition to that, you're very familiar with real estate investing and also the processes. And so, like one of my mentors said, a lot of times you can make money, believe it or not, by being told no. And so there's value in that as well. That might not be the right deal, the way to look at it, and that's why having people like you on our team is valuable. So again, you're at texasrepublicbank.com. And, the one thing I will say about your bank is that very easy to work with. The platform's very easy to work with. And, your staff follows up regularly. Very easy to get to, because you guys are obviously in the northeast corridor of the Metroplex for me, but I don't always have to go in because of your website, and easy to make deposits, and have rents go through your bank. So I'm really appreciative of what you've done for me.
Well, we appreciate you, Joe, and value you being a loyal customer of the bank. And you're right. You're a perfect example of someone. You're down there, south of Arlington, and we're up here in Collin County, and we've been able to work together. Technology has bridged a lot of that over the years. And so we, even though we're based in Collin County, we handle all the Metroplex. We run up to the Red River, Grayson, Fannin, Cook County, and then come down, south of Dallas and Fort Worth into some of those counties. So we probably got about 8 to 10 counties that we've got, that we actively do some lending in.
So if someone wants to work with you, do they need to go online and do an application first? Is that the steps?
I'm sorry. Say it. You broke up a little bit. Say it one more time, Joe.
So if someone wants to work with you, would they go to your website and fill out an application, contact you?
I would say the best thing to do is reach out to me directly by phone or email.
Okay.
And that's my email just popped up there. Certainly just shoot me an email, and then I can reply back and we can connect. I usually like to get on a phone call and talk. We can do a lot over emails, but at some point, I think it's good to have some connection and verbalize what someone's wanting to do and be able to give them some feedback.
Right. That's really good.
Yeah, but just contact me directly. And in my office, I have 2 other lenders. And so, between the 3 of us, we can get the investor, the borrower connected with someone to help them, see if their project is something we can all work together on.
Well, that's good stuff. So thank you very much. I've learned a lot as usual from you, and hopefully those that are listening have as well. Hopefully the market, from my side perspective, the market changes some over the next, year or 2, because it's definitely changed my strategy. When you're saying 9 to, 10%, that makes it tough for a buy and holder. So I've had to change, my sales a little bit and my strategy, but that's okay, right? That's just the way it goes. That's what you have to do.
Yeah, we're out there with you. Obviously, it's changed for us as well. We're not making as many loans. Our cost of funds have gone up, so it's impacted everybody. And so I think the key is just be smart. And honestly, as much as I hate it for not being able to do deals, whether as the lender or as the investor, sometimes it's best to pause and continue to build up some reserves and get ready to strike when either the rates come down, prices come down, or whatever the factors are that come down that make the investment more, make more sense.
Right. And to that point, I'm fearful with these property taxes and insurance hikes that some people might not, fare too well. And so that's, the fortunate thing for investors is that, we benefit sometimes when it's unfortunate for others, right? And I think that's going to be coming down the pipe because, I'm contesting my taxes right now, and I'm not getting very much relief. And I'll just say it that way. I'll get a little bit taken off, but it's kind of like the old adage when they offer you 50% off. Well, they marked it up 200%. So it just psychologically it might make you feel better, but still it's hurting your pocket.
Yeah, it's that's very true. I had some of my properties. I want to say it was about a 30% bump. I protested like you did. I actually have engaged a company to go represent me because I used to go do it all myself, but I just don't have time. But I've got a couple that come back with oh well we'll lower it 5%. So now instead of me going up 30%, I'm going up 25%. So yeah, I get a little bit, but it's the taxes are a challenge for sure.
Yeah,
I'm not there with you guys.
No, it's a tough deal. So I want to tell everybody to make sure that you continue to watch Real Estate for Life. We're going to have great people on here, just like Ron, that have a lot of experience and that can help you on your real estate journey. And in addition to that, if you want to learn how to do real estate investing, network, please join us at the Dallas Real Estate Investment Group, and that's dallasreig.com, and register there. We meet the first and third Saturday of every month, and you can come and network and again meet people like Ron and other experts that are in the field. And so with that being said, thanks, Ron. And we will tune in to Real Estate for Life next week and help you on your real estate journey. See you next time.